Welcome back, investors. Today we are going to look at how to analyze stocks. This is primarily a quantitative analysis. So we're going to look at certain fundamentals like ratios that will help us to look at the health of any given company. These are pretty universal between companies. However, the values that you'll be looking for here in the center column listed goal, those might differ slightly depending on where the industry typically runs at. And that has to do with the fact that there's just different requirements. Businesses operate differently. So we want to make sure that you're comparing companies against their peers and not against companies that aren't remotely similar. So today I hadn't originally planned to make this specific video. I had started working on an in-depth analysis of Nike. However, I got through looking at a lot of the data, opened up the annual report, and recognized that, hey, their 2023 annual report actually comes out in like 2 weeks. So it's important when you're starting to look at a company, and I am going to go into things to look for in the annual report on top of these quantitative factors. We want to look also at qualitative factors such as market position and competitive forces. Of course, we'll get into that here soon, but you also want to make sure that you're getting the most recent data. So if you recognize that more pertinent information is coming out soon, you sometimes may want to delay your analysis or to recognize that your analysis is somewhat incomplete. And that is one of the issues that I've picked up on here in the last couple weeks of making videos. Is it's currently June, and most companies in their fiscal year in December. So that means that there's been almost, about 6 months worth of business that's been operating, that when you're just looking at the annual report, you don't necessarily have that up-to-date information. So definitely important, depending on where you're at in any given fiscal year, you may want to actually start pulling in from quarterly reports just to kind of keep things updated. So that being said, I have not finished Nike. That should be one of my next videos. I think there's some interesting things to see in that company. But again, today we are looking at how to analyze stocks. And so we're going to scroll down here. Again, you want to make sure that the fiscal year that you're looking at is recent. However, something I want to know is you can pull up like Yahoo Finance and look at statistics, but the majority of these ratios that they give you are current. They're not necessarily based, you don't get multiple years of information on all of them. Some of them, like trailing price earnings ratio or price to book, they'll give you 3 years worth. And I'm looking at, of course, the free version of Yahoo Finance. I don't like to pay for those services when I can get most of the information for free online. But an even better source, though, for finding that historical data would be a site like Seeking Alpha. They provide you 5 years worth of data for free. You sign up for their little email list, and you've got access to 5 years worth of data for any company out there. So that's a very valuable resource to have. And if I didn't actually say it, you don't want to look at these numbers at just static points in time. Although these numbers represent static points in time, you want to make sure you have enough data on a company to recognize trends or patterns, and to recognize what direction the company is moving in. So I like I said, I like to look at qualitative and quantitative factors. I think you have to balance those two things together. So one of the more quality related factors is ISS governance scores. I don't really know anybody else who looks at these, but if you go to Yahoo Finance and look under the profile section that describes the business, there at the bottom of the page they give these scores, and they're between 1 and 10 for these 4 areas: audit, board, shareholder rights, and compensation. Really, 1 is the best, 10 is the worst. So you really want to see at least somewhere around 5 or lower. However, there's plenty of good businesses out there that, their compensation packages are a little rich, but the business is doing well. So you can take some of these with a grain of salt, but also recognize, I like to see if there's an audit score of 8 to 10, that tells me that there might be some negative aspects to either what the auditors have picked up on in the company, or that I need to really dig into some of those notes in the annual report to determine, how are they smoothing out some of the numbers, or how are they booking their revenues? Are they, doing it by like percent of completion, which is a way of delaying revenues, or are they really booking things at the time they're incurred? So these qualitative things can also work towards you finding more quantitative factors and information. That said, I look at 3 main areas when I'm looking at the fundamentals of any company. I want to look at their working capital, and that primarily has to do with cash and current assets, and figuring out whether they're liquid and solvent as a company. I want to make sure that they can meet their obligations. If they do have debt, I want to make sure they can pay their debt, and really just not only stay in business, but operate at a high level. The next level of factors that I look at is capitalization. That has to do with how is the company funded. Every company makes money, but it takes money to make money, right? And so there are 2 primary ways that companies get their funding. They can do that through debt. They can take out loans, short-term or long-term, or beyond those kind of liabilities and payables, you have equity. So investors putting into the company. And, if you were looking at your personal balance sheet, so to speak, equity would be the same as, say, your net worth. So really, that's part of what I want to look at a company is, at what point do their assets and the thriving part of the business outweigh indebtedness or the liability side of their business. So after capitalization, after working capital, the last thing I look at is profitability. And of course here, if you're looking at the screen, you see profit margin, operating margin, return on assets, return on equity. Those have to do with profitability. However, I put those up earlier in this format here because I see it as a review of management effectiveness. So before I jump into some of these other numbers, if I don't have positive numbers here, I know I need to look a little deeper into some of these other numbers to see why they're not running at a super profitable level. Of course, I don't always have multiple years of data here because I'm going to do that later on when I actually look at those margins over time. And so, current price, when you're first looking at a company, current price is driven by primarily trading. Buying and selling dictates the price of the shares. And so, that's kind of a subjective factor. That's going to change. It's going to fluctuate. However, I do want to see that a company's price is at least trending up. If I buy a company, I want it to, earn me money either through capital gains or dividends. And so, it is one of those things where when the price is going up, that is something valuable to you as an investor. And if it is low, I want to see why. I want to see if there's any indications that it might improve, that the market might be realizing underlying value there. And so that's why I include that in here. But again, some of this early stuff is just to get a general sense of the company. And as we go farther, we're going to dig into what we're specifically looking for. So as we move down, we have to look at their earnings per share. Essentially, after you take out everything, this is how much the company has, this is their legitimate profit, their bottom line, so to speak. And so earnings per share is looking at what's actually left over. What do the stakeholders, the shareholders, what hopefully is going into their pocket. You want a company that has high earnings, especially high earnings per share. And I'll often look at the diluted earnings per share because that takes into factor, preferred shares and debentures and all of those kinds of things. And it helps me kind of temper that value because it typically is lower. That is one of those things we want to look at over time. You want to see earnings per share increasing. Again, that's a healthy sign that the company is doing better and better. And with that comes the price earnings ratio. And I don't want to, under explain or over explain here, depending on where you're at in your investing education. Some of this might be over your head. Some of this may be just way too basic. And so, hopefully I'm meeting you somewhere in the middle here. But as far as your price earnings, that's telling you at what multiple of those earnings per share the shares of the company are trading at. And so I like to look at both the trailing 12-month and the projected forward PE. And really, ideally, you don't want to be paying too much more for those earnings. And so a lower PE is typically better. I like to see at least lower than 15. A lot of investors typically will sit around 25 times earnings is a healthy place. You look at some of the, tech stocks and those kinds of fast growing companies, and you'll see really high PEs, even up into the hundreds. And that, again, has to do with industry. So you want to compare companies to their peers, not just in a vacuum. And a lot of auto companies, they trade in, sub 10. Ford and GM, I believe, have been sitting around 5. Whereas you have Tesla, who's also an automotive company, but it really functions more like a tech company, and its PE, price earnings ratio, has been sitting around like 76. So it's going to be different, even sometimes within the same industry. And that's part of why you need to understand the company to be able to understand what those numbers are telling you. And so, again, this is the multiple of the earnings that people are willing to pay. If they value it highly, then they're going to pay a higher multiple. But it's nice when you can buy it for a cheap multiple, because when the market recognizes the value, it'll start trading up higher and the price will start moving, and hopefully the earnings move with it. PEG ratio is price earnings growth. I like to see less than 1. That tells me that there's some unrealized growth that's going to take place that the price is not yet reflecting. Again, this is kind of you can't tell the future, right? And so you have to take some of those things with a grain of salt. But, typically we do trend it out based off past data, which past data doesn't determine future results. But, using the best information we have, PEG ratio does tell you something. Book value per share, specifically tangible book value per share, tells you what kind of assets the company actually has. And, worst case scenario, you buy a company and it actually does really poorly. They have to liquidate, pay off all their debts, and then turn around and hopefully, you walk away with something. That tangible book value gives you a rough estimate of the liquidation value of that company. If they had to sell everything tomorrow, would you walk away with something or nothing? And so I like book value per share because it does give some sense of that underlying intrinsic value. But again, if you're looking at tech companies, a lot of those things are in trademarks or software, not necessarily super tangible things, and they're assets nonetheless. But you look at Coke, and its trademark is a significant item on its books, so that's something to take into consideration. Next, I like to look at price per sales. This one I don't place too much stock on. I just want to use it as a just kind of a guidepost, really, more than anything. I like to see less than 2.5. Again, you compare it to the industry, but really, the main thing is that it's just not outrageous. There was a lot of companies, even in the last 5-10 years, that were trading well over 100 times the price per sales. So that obviously wasn't sustainable. Most of those companies have lost a lot of their market capitalization when people recognized that it, one, wasn't sustainable, two, wasn't going to even out, and three, eventually something had to give. And so as we continue, all of these, except maybe this growth level, we do want to trend out. And I haven't mentioned this, but that far right column, CAGR, that's your compounded average growth rate. That is, instead of just being a direct linear average, will take into effect the effects of compounding. It will take into account the intervals in which the changes occurred. And so you're going to get a more realistic investment average out of it, rather than just a linear progression that might be pretty inaccurate. I like to look at revenues. This money that's coming in from sales. I want to see that increasing at a fairly steady rate over time. I don't like to see big sways and jumps, but also, if they're doing really, really good, I definitely want to see those and recognize the good years with the bad years. Gross profit tells me, with their cost of sales and their sales, where are they spending more and more to create their products or get those things sold than the increase on the revenues or not? Is the bottom line increasing too much beyond what they're actually able to pull in? That's an important metric there. You want to see that gross profit increasing. You want to see a larger and larger gap between revenue and those cost of goods sold or cost of revenue. And then operating margin, that's your cost of goods sold divided by the revenue. A lot of companies now, instead of cost of goods sold, they'll put cost of revenue. And unfortunately, that includes, occasionally it'll include like marketing and different things. And so you do have to take that with a grain of salt, because there are probably pieces of information that are worth taking out of that, which would reduce that operating margin. Or maybe even increase it, I guess. But again, operating margin, that's something you want to see increasing over time as well. That is a profitability metric. I like to see that there's been a history of past growth. Again, analysts will put in like a next 5-year growth. I pull those two numbers off Yahoo Finance. And again, both of those are grain of salt. I like to see a good history of growth, but also I do like to see that analysts are looking at it favorably, that they're seeing something positive that should result in growth. And occasionally they'll understate it, and so you want to take that into account. Operating cash flows and levered free cash flows. So you want to see, at the end of the day, they have cash left over. They have plenty of cash to pay their debts. They have plenty of cash for what are called capital expenditures that they can invest in property, plant, equipment, expanding the business, research, development, those kinds of things. And then levered free cash flow, the ability to pay their debts down while also operating the business well. So you want to see those increasing, but primarily you want to see them large. I like to see it larger than the total debt. That's not always the case, but I want to see it to where, maybe more than 1/10 of the total debt. I like to think through how long would it take them to pay this all off to be in a positive cash flow situation. Current ratio and quick ratio, and then inventory turnover and days inventory. These are all working capital ratios. Again, these have to do with cash and cash flow. and they're primarily pulled from your balance sheet. Inventory turnover is going to pull from the income statement, but current ratio is just your current assets to current liabilities. That tells you, how liquid's the company. Can they meet their current obligations? I like to see more than 2.5. Typical wisdom says 2. And again, I want to see that either increasing or stable. If it is stable, I want to make sure that they're not floating that ratio with debt. Sometimes companies want to project to shareholders that, their cash situation is stable, but you have to look at that underlying debt to make sure that they're not just floating it so it looks good, but really there's some unhealthy trends going on. Your quick ratio is the same thing, but we're going to take out inventory. Trouble with inventory is it's the least liquid of all of their current assets. So just because you have hundreds and thousands of units in inventory doesn't mean you can move them, right? It doesn't mean you're gonna be able to make the sales. So if we take that out, that tells us, okay, how much actual money, actual usable current assets do they have on the books to meet their current liabilities? And again, you want at least 1. I like to see it growing. I like to see it well over 1, but you at least want to see it stable over time. And that ensures that they're in a good position to be able to actually pay their bills. Inventory turnover and days inventory. This is looking at how quickly a company is working through their inventory. And so you're going to take your cost of goods sold and you're going to divide it by an average of the current and last period inventory combined. And you want to see a higher number. Ideally, you're seeing more than 4. That's telling you how many rotations of their inventory they're moving through at a time. Now, again, this depends on industry. Airlines are going to have a pretty slow inventory turnover. However, if you're looking at retailers and stuff, you want to see a pretty high inventory ratio, and hopefully you're seeing it increase over time. And then days inventory, you're going to take 365, the number of days in the year, and you're going to divide it by that inventory turnover. And your goal there is, this is telling you how many days on average it's taking them to move a given piece of inventory. And so really the gold standard is 30. You want to see them move every piece of inventory they have and every single month, but really realistically less than 90, maybe less than 75. Good places to be. And really this is one of those areas you just want to see a trend, right? You want to see a lower and lower trend, whereas on your turnover you want to see a higher and higher trend. And that tells you there's a healthy pattern going on. As I mentioned with current ratio and quick, especially current ratio, you want to make sure that the cash that the company is holding is leveraged more in equity and assets than it is in debt. So debt to equity and debt to assets, these you both want to see decreasing, because the more they decrease, the more that they're leveraged in equity and assets than they are in debt. And this can kind of tell you whether a company is moving towards being over leveraged or whether they're paying off those debts, which again, you can see that in the cash flow statement over time, but also, balance sheet is kind of an important area there. I like, icing on the cake is always that a company pays a dividend. You get paid for being a shareholder. That's incredibly important to me. That's not the case for all investors, especially if you're looking for like growth stocks. There's a lot of companies a lot of healthy, good companies out there that don't pay dividends. Personally, as as a value investor, as someone who prioritizes shareholder rights, I believe that the profits are owned by the shareholders. And while I want them to invest back in the business, I also want to make sure that they're treating the shareholders with respect. So not to say I like to see an increasing dividend over time. I like to see that they can cover that dividend along with cash flows. And, if a company is consistently paying, they don't cut them, and they're consistently increasing, that can be a really good sign of financial health. And of course, you want to make sure they're not overextending themselves. But again, just looking at that factor, it's important. And insider ownership, I do look at that. I feel that the higher that number is, the better internal sentiment is. The more that people who work at the company own the company, I think that they're more literally invested in it. And determined to see positive outcomes. It also means there's just less institutional investors, less retail investors who would be more flighty. And I think it can help keep a company more stable. I like to look at market share if that data is available. Sometimes in the annual reports they can state this stuff. Sometimes it's so fluid, they don't have those metrics. So something I like to look at, but not always able to get that information. Again, so this has been really quantitative. We've looked at numbers, we've looked at trends. We're kind of getting a picture of how the company is run, but it's so important that you actually read at least one annual report for the company. I think Warren Buffett, Benjamin Graham, all of these great investors, almost all of them suggest reading at least 10 years of annual reports. And what this tells me is, the goal is not always to invest in as many companies as possible. It's to invest in as many quality companies as possible. So you can't really tell how good of a company it is without reading their annual report. You get all of the information straight from the horse's mouth. Now, it's important to know annual reports are both a PR document meant to convince you to buy and a disclosure document with financial statements. So you definitely have to take it with a grain of salt depending on what statements are being made. But there's some really important things that I look for in there to kind of help me see through the fluff of painting things in a really positive light. So the biggest thing, and these two are kind of the same, where do the revenues come from? I.e., how does the company make money? I want to know, what are the business segments? How do they operate? What are they working on? And just the general mix that the company is. How diversified are they? What subsidiaries do they operate through? And just getting a general sense of, if a company is basically operating, the revenues all come from, government funding or something like that. Well, that's not necessarily sustainable. I want to see that those revenues are actually coming from the products and services that the business provides, and that they're doing that in segments that they have competitive advantage. I want to see, who are the company's competitors? How do they stand? What are their plans to create a bigger market share in light of competitive forces? I take a lot of stock. I want to see what the auditors say. Sometimes they'll just write off like, yeah, we see it as, fairly representing the results. That doesn't tell you anything. But ideally, there's some good notes that they're pointing out. Yes, there's, this represents it fairly, but also these are some things as an investor that you need to be noting. And that kind of gives me a direction to kind of go back and review certain things on their books. Obviously, looking through the financial statements, there's a lot more, small little breakdowns and stuff in the annual report than you would get just, pulling them up online. And really probably the most important section, and unfortunately it's one of the longest section, is the notes to the financial statements. You find out a lot about how the company posts to their books, how they book their revenues, where those things are coming from. You find those out in the notes, not necessarily in the management and executive discussions. So definitely dig through those notes, because you'll find a lot of important stuff to consider. I like to consider contingent liabilities and assets. The biggest one for most companies, for me, is looking at litigation that's ongoing. Are they in a lot of lawsuits? Are these big lawsuits? What kind of financial ramifications might they pose for the company and for me as a shareholder? What are the risk factors? This is beyond just litigation and stuff. This is looking at competitive forces. It's looking at, a lot of companies have to worry about supply chain, or they have foreign exchange risk because they operate in multiple countries, or they, depending on how many suppliers they have, maybe they're dependent on one for a critical component of whatever product they make. Well, that's something I want to consider and understand the health of that other company to make sure that they're going to be able to continue to provide that for the company I'm investing in. I also want to see capital expenditure plans. How are they planning to invest back in the company? What research and development are they doing? What products are they going to start emphasizing? And then also something to note is there's a difference in an annual report, in company statements and shareholder meetings, there's a difference between disclosure and transparency. Disclosure is a legal requirement. That means the company is legally obligated to lay this information out. The problem with, disclosure only is there's no interpretation. They're not breaking it down so that you can actually understand it. It's just that the information is available. Transparency, on the other hand, involves disclosure, but it also involves disclosure in a way that you can actually understand it, that you can actually process it and come to realistic conclusions. So that's something to consider. Unfortunately, not every company is honest. You can look at Enron, WorldCom, so many different examples of companies that haven't been 100% honest or not dishonest, I guess. So something to consider is not all those things get caught, but a good sign of whether a company can be trusted or not is how transparent they are beyond just disclosure. Lastly, you want to look at moat, competitive advantage. I've kind of touched on this, but really just how important is this company to a given industry? How hard is it for new competitors to show up? What size of market share do they have? How strong are they operating? Those different things that are going to really help them to stand out. And then again, I'm not going to go into all of this, but two key things to consider after all of this before you ever buy is, what is the intrinsic value? What is the company actually worth? And therefore, how much is it actually worth per share? Maybe it's a great company, but if I'm paying way more than it's worth, then it doesn't matter how good of a company it is because I overpaid for it. That's important to me. That's a big key to being a value investor. And if you're not a value investor and that's not something you care about, totally fine. But as a value investor, I see that as really important. I want to buy good companies and I want to buy them at a good price. And then lastly, margin of safety. So not only do I, buying at a good price ensures that I've bought it at such a good price that I'm going to have a solid return on it. And so just because you buy it at a good price doesn't mean it goes anywhere. So I want to see the stock appreciate. I want to see them be able to pay dividends for a long time. And so I want to buy it with some degree of a margin of safety. And I can go through in a later video and kind of describe how you come about to an intrinsic value, how you come about to a margin of safety. But that's way beyond the scope of this video, and I've probably already taken too long. So I appreciate you if you stuck with me this long. If you got something positive out of this video, let me know in the comments. If you have questions, concerns, if I said something really stupid, leave that in the comments as well. Part of why I post on YouTube is because I can get such honest, direct, and quick feedback on my ideas. And ultimately, hopefully I'm learning as much as I'm being able to put out there and hopefully help others. If you like this video, if you want to see more, if you're interested in seeing me actually work through and break down new companies, definitely subscribe, like this video so you don't miss out. And of course, if you want to see a specific company analyzed using these factors, well, drop that in the comments as well. I've done a couple of those already. I got some good feedback on those, and so I want to continue to do that because again, if it's valuable to somebody, if it's a company they want to see, then that's better for me. That allows me to pursue beyond just my typical area of expertise. So that being said, I appreciate you tuning in. I appreciate you sticking with me. And again, comment, like, subscribe. Dig in, analyze stocks, analyze companies, and most importantly, invest well.